spirits to everybody. I hope you guys are surviving all of this. I appreciate you jumping on. The point of this call, of course, is that we're going to go over credit. This is really, if you're a realtor, this is so you can understand the background and the behind the scenes of what we are looking at from a credit standpoint, so that when you're in your phone, when you're in the car with your clients, when you are talking to them on the phone and they mention things, you can kind of have a basic understanding about what it is and what is credit and what are the big questions that always come up and how can you address them. And then if you're on this call or you send this over to one of your buyers, or you are a buyer or just a borrower, what I wanted to do is just really go over and dispel some rumors and some misperceptions about credit, because I hear the same questions all the time. And I wanted to really kind of clear up what some of the fallacies out there are about credit pools, and then what are some basic things that you can do and some ideas to either maintain a good credit score or to build up your credit score. So I'm probably going to talk for about 20 or 30 minutes or so, and then we'll open it up to any questions. And at the very end, if you would like, I'm happy to share the PowerPoint, and you can give it to anyone you would like, blast it on social media. This is here to really educate everybody. So without that, obviously, we're going to talk a little bit about credit. So today's agenda, why Guild? That's going to be pretty obvious. We're going to talk about how is your score calculated. We're going to go over why is it important. We're going to go over 5 or 6 steps to better credit and give you some really, really good ideas from my buddy Jeff Sipes, who owns and operates Blue Water Credit. And then 5 or 6 ways to raise your credit score. So let's go over some basics about credit, okay? First, why Guild? This is the promotional thing. You don't need to use Guild. This is for informational purposes. But if you'd like to, you get myself and my team and 18 years, or actually if you add up everybody, probably 50 or 60 years of experience to help you navigate all of this, okay? So we're local, and I love to help, and I'm glad that you guys are all on the call today. All right, so let's talk a little bit about credit. What is a credit score? So when I'm talking about credit scores today, I am talking about the FICO score, which is the Fair Isaac Company credit score, okay? When we are doing mortgages, we pull what's called a tri-merge score. So there are 3 main bureaus. There's Experian, Equifax, and TransUnion. They all have their own algorithms on how they generate a score. And so it is very rare that you would have the same score across the board. And the reason is because each company extrapolates and calculates what they view the credit score would be. Okay, so we use a tri-merge, and then we use the middle credit score of that tri-merge score. And if there's 2 borrowers or more on the loan, we're going to use the lower of the middle credit score. You don't get to cherry pick the highest score. You don't get to cherry pick the best borrower. One common question I get is, well, can I use my income from my husband and only my credit score? No, it's kind of all in or all out. So that's how we have to package together. So a credit score is going to give you a numerical value that kind of gives you an assessment of the credit worthiness of a borrower. So you can see it goes all the way down to 300 and goes all the way up to about 850. Now, if you hear someone say, oh, I have a credit score that was 920, they're not looking at a FICO score. There's only this range. 850 is the highest. And I don't know that I've seen in 18 years more than about 3 people with a score above 840. It's pretty, there's a kind of a weird, you got to have about 3 or 4 open trade lines. You got to be with very, very small balances and about 78 years old. That's how you get a 850 credit score. So in mortgages, you got to have a minimum credit score of 580 to do an FHA loan, and it's incredibly difficult. Anything above 600 is going to be a little bit easier to get through, but still very difficult. So the hierarchy is really 740 and above is considered perfect. And then it goes down in increments of about 20 points from there, 740, 720, 700, or 720, 700. Once you go below 700, your interest rate is going to change on a conventional loan for sure, and it starts to bring in a little bit of other things. So we have a wide range of how people can get to a particular credit score, okay? Why is the credit score important? No one knows who the individual borrower is, so they can only look at the past history as an indication of the likelihood that a borrower is going to repay or default on future payments. So it really affects everything you do. It's going to affect buying a car, it's going to affect buying a house, affect what your interest rate is on a home, on a mortgage, getting into an apartment complex. So having a credit history that shows the ability to handle and manage and timely make payments is huge. And the earlier you can start to build that history really makes a big impact. The lower your credit score is, the higher the likelihood that you're going to have a payment default in the future. And that's going to affect the interest rate. So that's why credit scores are so important. Now, one of the first big questions I always get is I pull credit. Kevin, we're going to use you an example. I say, hey, Kevin, I pulled your credit score and it came out as 680. Kevin says, are you kidding me? How can it be that? I just pulled my credit score and it said I was a 780. Okay. This is the difference between a mortgage lender's credit report and a consumer report. The reason why there's going to be different credit scores is because the information that is being pulled is different. So on a consumer model, it's really only credit reporting based off of credit cards and installment agreements, maybe a car loan. It will not always populate in mortgage lates or tax liens or bankruptcies or foreclosures or other balances. The way they calculate out the credit score, the way they view higher or lower balances, and the actual data that they pull in is different. So I would say 9 out of 10 times, if you hear from a client that they have a 720 credit score and you ask them, oh, well, I pulled it from freecreditscore.com or some online, you should probably knock off about 60 points on what a mortgage lender's credit report is going to show. It happens all the time, and it's the difference in, again, the information that's coming in that's being reported. Okay, so it's really important when you're talking with clients or you're looking at your own credit report, and if it's online, it is probably going to be a lower score when you actually pull it through a mortgage company. Okay. All right. So what does the FICO score look at? So what's the criteria that they're looking at? They're looking at trade lines. Those are an account. So one credit card is a trade line. So if you have 3 credit cards and 2 cars, that would be 5 trade lines. So each trade line has its own reporting history. It's going to talk about what the outstanding balance is, the original balance, and the payment history. Okay. Credit inquiries. The credit score will look at credit inquiries. Now, I'm going to get to that in a second because people really have a hard time with getting their credit pulled initially, but they do look at the number of inquiries. They also look at collections and then, of course, public records. So collections, those are bad debts. What I should have included in here are probably charge-offs. So there's a collection account where that's where you owe RC Willie, you never finished paying their bill, or a medical bill. That's the most common one. You owe $10,000 to Kaiser, you don't pay, then they will sell that account to a collection company, and then that collection company is going to bang you for money again and again and again. That's a collection account. A charge-off is a little different. A charge-off is going to be a credit card that you don't pay, and then, Visa or whoever through Cap One just takes it as a loss, and they're not seeking to collect any money from it. Okay. They are treated a little bit differently on scoring purposes. And certainly from a lending standpoint, charge-offs, we don't care about. Collections over a certain amount of money, we have to start now dealing with what that monthly payment would be. So something to consider. And then public records. So whether you have a lien filed against you, whether there's been a bankruptcy or foreclosure, those are items that show up on public records. That can also have a negative impact on your credit score. Okay, makes sense. What's not considered? Easy. Age, address, employment, gender. People ask me all the time, well, I make $200,000 a year. Is that going to make my credit score go up? No, that has nothing to do with your payment history. And guys, let me tell you something. been doing this for 18 years. I know a lot of very wealthy people that don't make payments on time. So the income level has nothing to do with people's ability to manage, organize, and pay bills on time. Okay. So big question. Well, I don't want my credit score to be pulled because it's going to have an impact on my credit. I don't want my credit report pulled because it's going to have an impact on my credit score. Not really. It's a common misperception that if I pull your credit, it's going to make your credit score go down. Or someone says, oh, well, you pulled my credit and now my credit score went down. That's not really the case. This is a chart from my buddy at Blue Water Credit. And this is something that he will use for credit. I want you to look at this pie chart. You see where it says credit inquiries of 10%? That's it. So that means that if someone pulls your credit, it only counts for less, 10% or less than your overall score. So the issue is really, the issue is that if you have a lot of credit inquiries, that is what is going to really have an impact on the credit score. Hang on one second. I got someone's microphone. Let me see if I can mute everybody here real quick. 1 second. Can I get to my Zoom call here? There he goes. Well, whoever muted himself, thank you very much. So, okay. So credit inquiry. So 10%. So really, when you're talking with a borrower, okay, you really can't let them get away with they don't want to have a lender pull their credit score out of the gates because they're afraid of the credit score. So the best analogy I can give is for all of us who have children, we have children and they all get report cards. And those report cards are going to have a grade on there. So we're going to just say, let's say our kid's got a D on the report card. If I go into my kid's grade and I pull it online and I see that they have a grade of a D, my pulling that report card has nothing to do with the fact that they got a D. It's that they blew a test, they didn't study, but I'm just pulling the data that's already there. That's the way to think about your credit score pull, is that the data is already there. So if your garage is a mess and I come by and I take a picture of it and then I say, hey, messy garage, I'm not causing the garage to be messy. I'm just taking the data. So where we want to tell people is that what really changes the credit score, and I'll go over this in a second, is the credit utilization. It's running up balances. So if you have a $10,000 credit card and I take a picture of it today and there's a zero balance, and tomorrow you go out and you buy yourself a trip to Italy and you have a $9,000 balance, and then you were to re-pull the credit, you're going to have two different credit scores because it's the use of the credit. It's your payment history. It's the amount of credit that you're using that really impacts the score. So where you can run into trouble is that you can have people that have 10, 15, 20 pulls over a 30-day period. When you have that many pulls over a 30-day period, you're going to see a lower credit score. But the only people that have their credit score pulled that many times tends to be those that have really poor credit to begin with. So most of you who are dealing with borrowers, they're not going to have super, super low credit to begin with. And so that initial pull is the first one that only would have an impact. It may count 1 to 5 points. And then if they go and shop to somebody else, and they have their credit pulled 1 or 2 more times over a span of 30 to 40 days, it's only the first pull that counts, and it's only a point or so. And unless you're right at a borderline, like 700, you don't want to go below, it really has no impact on it. So we always want to tell people, I'm going to give you the data. It's not going to have an impact. I'm just pulling down data that's already there. And wouldn't it be nice to know what you can work on today to set yourself up for a better loan or better or lower interest rate and better terms in the future, rather than call me on a Friday, get in a contract, and then say, oh, by the way, your credit's not so good. And had you known and you had 2 months, you could have fixed it. So that's how I always encourage clients to let me pull their credit. Going over the other types of how your score is calculated. Obviously, you have a mix of credit types. That's going to be installment loans and credit or revolving debts. Those are credit cards. Those are different types of scoring models, but it is part of it. Your credit history. So sometimes you can have people who live on cash and they don't have a lot of credit. Well, if they don't have a lot of credit, that's also a problem because there's not enough data to generate a judgment call or that score to see whether they're going to have a credit problem or not. So we always want to have a little bit of activity, okay? And then the biggest one, of course, is the payment history, right? That's a no-brainer. If you make your payments on time, you're likely to have a very, very high score. If you make your payments not on time, your score is going to start to drop. The other big one is outstanding debt. So one of the things we'll talk about is not blowing up your debt. Not only is it bad for your credit score, but it's kind of bad for life in general, right? Having too much debt is problematic. It will lower your credit score. I can almost guarantee you will miss a payment here and there, and then your score is going to go lower. It's also quite stressful to always be managing that debt and extremely expensive based on the interest rates that they charge. But that's for a budget class in a different time. So next class here. So credit inquiries, we talked a little bit about that. There's 3 types. There's a soft inquiry, there's a promotional, and then there's the hard inquiry. So a soft inquiry is really what you're going to do as your own consumer. It's just kind of like a little peek behind the curtain to see how you're doing. It will also be a pull from a current credit card that you already have. If you call maybe to have your credit score or your credit balance increased. Promotional, you see those all the time from credit card companies. They want to offer you a card, but they're going to do a quick little check before they offer it to you. And then what we do in the mortgage world is a hard inquiry. And that is why, remember at the start, we have a difference between what you pull and what we pull. On our hard inquiry, it's going to be very, very thorough. And it's going to be a real deep dive into what is your credit history and everything look like. Now, how do we improve our credit score? So I'm going to go through this slide a little bit quicker because it's not my favorite one on what I want to talk about, but I think it has some really good points. So first of all, step 1, check your report to see if there's any errors. I would say there's probably always an error here or there on most people's reports. This is all data entry. Someone is getting paid minimum wage to enter in data. And there are typically a few things here and there that you can adjust on the credit report to increase your credit score. Negotiate a settlement with creditors. Remember, these collection agencies, they basically buy an old debt, and if they can collect about 5% of their overall debts that they own, they're doing pretty good. So if you can call and you can negotiate a settlement, you say, I will pay you money, but you are going to send me a letter back clearing this out. That will help increase your credit score, okay? Pay off all your past due balances. And for sure, what's not included here, credit card balances that are over the limit will sink your credit score, okay? Avoid new credit card applications and large purchases. So the balance transfers that people like to do, those are new inquiries, those are new credit cards that show up, and it's just showing more activity. So kind of the idea that I've always thought about with credit is you got to think about the credit bureaus are like old fat bankers that sit around and make judgments on you about how the world should work, and they still think we should work on a cash basis. So if you are now getting credit, that means you don't have cash, and that means you're in financial disarray. That's kind of the mindset I always feel that credit reports have. So the more you move money around and transfer balances, rob Peter to pay Paul to get that lower 0 interest rate credit card, all that activity starts to tell the system something's not right. You're really moving a lot of money around. What is going on? And that score is going to come down a little bit. And then obviously pay future bills and debt on time. That's just the number one. That's a good life lesson that we should all know about. Okay, tips to get your credit score up 100 points or so. These are not guaranteed, so please don't send me an email or scream at me because you did something and it only went up 50 points or 90 points or not at all. But these are general ideas that I like for people to think about as they start to learn to think about how to manage their money and their finances so they can get a better score. So and for those of you who know me, and some of you are on this call that I have worked with before on budget and managing finances, I do not like debt. I sell debt for a living, but I do not like personal debt. However, for credit scoring purposes, there is a sweet spot on your credit cards between 1 to 10% of the limit. So if we are trying to build our credit for whatever reason, keeping a credit card balance of 10% seems to give you the highest jump. If your credit's fine, pay off your bills every month, enough said. But if we're trying to increase your credit score, pay down the balance to 10%. Under no circumstances do you ever want your credit balance to go above 30% of the outstanding limit. Anything over 30%, that's going to pull down your credit score as well. Okay, so we want to just manage that, get the score we want, and then you're going to pay off the credit card. Settle collections for deletion. The key word in that slide is deletion. You can negotiate. They want your money and you want something else. Now, don't let the first person tell you that they don't have the ability to change what's reported at the credit bureaus. That's not true. They can. It's a coding system. So what I tell a lot of clients is, listen, I will negotiate. I will pay you 50%, whatever you can. But in exchange, you're going to send me, and here's the key, guys, a letter in writing in the past tense that says this item, this collection has been deleted from the credit report. Okay. It's really key that it's in the past tense and you use those words because that's what will allow us to clean it up on the credit report. Add spouses, good credit cards. Okay, this is a little game we play sometimes. If someone needs a little bit of a boost, we'll have one spouse or a mom or a dad that has good credit history, add a kid or a spouse to their credit card, preferably as an account holder, not as an authorized user. And then the parents or the spouse's good credit history will populate onto our clients or your credit report as a credit card, and that history will help populate in and you get all of the good credit from there as well. Okay, so it's a nice little trick. The flip side of that is sometimes removing an authorized user account. So especially, I see it all the time. Borrower comes in, hey, what's this Amex card for $35,000? Oh, well, that's my dad's card from when I was a kid, and he's a contractor and he uses that for business. And so now we have a credit card that's maxed out. Remember, maxed out over 30% of the balance. That's going to pull your credit score down. So all we would do is we'd have dad call the credit card company and pull off the client, the kid, from that account. Once that authorized user account falls off the credit report, the credit score is going to go up. Okay. Open a secured credit card. This is really going for a first-time home buyer or someone who tends to be young and has no credit at all. You're going to go to a credit union. A credit union is going to take $500 from you. They will then give you a credit card back for $500, and they will report that to the credit bureaus. So what's going to happen is now you have a revolving card that is being reported to the credit bureaus, and after about 30 days or so, that'll populate up. And now you have a good payment history, low balance. That will help with the credit report. And then, of course, I got to give a little bit of love to my buddy, again, Jeff Sipes over at Blue Water Credit. They're legitimate, they're authentic, they're honest and transparent, and they can always give you ideas. I call him all the time, hey, how do we move this around on things that you can do? A credit expert, they are, companies will charge a fee, but it will increase the score a little bit quicker for you. All right, recipe for the highest credit scores. Again, payment history, pay your accounts on time. Credit cards, try to only use 1 to 10% of your credit card limits. Now, I only have 2 credit cards. I believe you don't need more than 2 credit cards. Macy's, Old Navy, Home Depot, Target, 5 different visas. All those things fall into the category of missed payments. And the way, well, I'll come back to why does my payment drop when I have a late payment? I'll come back to that, but it usually has to do with having too many credit cards. Okay, length of credit history. Keep your oldest accounts open, especially the good ones. Only open new accounts when necessary. A lot of this has to do with time. So if you have an old credit card that's zeroed out and you don't even use it, just cut up the card, but just leave the account open. Check your credit score every once in a while, make sure nothing's going wrong with it. But the credit card companies don't know that you've cut up the card and you're not using the card anymore. They just know that every month that thing posts a zero balance. It's got a $5,000 credit limit and you never miss a payment. That will help boost your credit history, okay? I would probably not apply for a lot of new cards. Go to your current credit card company and have them expand your credit limit rather than opening up a new card. It will help with your credit score. Not only are you not going to have a new inquiry and a new card, but now if you're carrying a little bit of a balance on a current credit card and the credit limit goes up, now you have more credit available, and that will improve your credit score as well. And then the number of accounts open. You kind of want 3 to 6 accounts open, 1 to 5 cards, 1 installment loan, which would be a car loan or a boat loan, something that has a set term that's going to be paid off, and then 1 or 2 mortgages. Okay, that's how you're going to get a really, really high credit score. When should you settle bad debt? This is really something that should talk about either with me or somebody else on a particular basis, because if you have collections that are on a credit report that are really, really old, it goes into the reporting date. Remember, these are only computers. So if you have a date from a collection from 10 years ago and its last was reported in January of 2010, and then you go in and you pay off that collection, the credit report's now going to show paid collection 1 of 2021, and your credit score is going to drop like a bag of sand. So this is something that we should probably talk a little bit later. There is a way to do it. There is a process to paying rate of those debts, but you got to be really, really careful about that. And I always advise clients, don't pay anything off until we talk, so we can be super specific about what needs to be paid, how much, and how you should attack it. Otherwise, people can just destroy their own credit report. Raise your credit score, creates credit stability. That's what we've been talking about. Know your limits. Make sure that you don't go over your limit, and try not to go over 30%. But going over the actual limit that's not good either. Take some credit. You want to have a little bit of good credit going all the time. Protect your interests. Okay, this is what I tell most people too. Look at your credit score. Call me. I'll pull your credit every 3 months or so. It's not going to have an impact on your credit score, but it will help you find out any problems that you have in the future. And then even the score. You have a right to dispute inaccurate information. So if you do things on your credit score that are not accurate, you have a right to dispute them. Okay. So I have one final question or thing I wanted to share with everybody about that before I open this up for answer or questions. People will come in and they will say that, well, really 2 things. One is they will say, hey, I had a 780 credit score and I had 1 late payment on a tiny little credit card, that, you know, that little $6 credit card that's just floating out there. People miss it. And then their credit score goes to 690. And why is that such a big drop when somebody else maybe has a 710 and it goes to 690? And the best analogy that I've ever heard is you kind of got to think of, again, a report card. So if you have an A in a class, the whole semester, you have an A, and then that last quiz, it doesn't mean a whole lot, but that last quiz, you get a C on. You can't, by definition, still have an A in the class. You have to drop far enough to get you into the next highest tier, which would be a B+. So, you know, imagine like an apple tree. If you're a really shiny, beautiful apple, you're at the very, very top of the tree. Well, if you get dinged or a worm gets in you, you're going to fall lower on the tree because you can't be perfect anymore because you're not. And so depending on how high you are up on that tree or how good of a grade you have, you can have a larger fall to the next level than other people would based on your own criteria. So everything is super, super specific on the credit report. All of this is super important to know, either as a realtor, to help your clients understand that there are things that can be done. I've always said, please, let's look at everything up front, because people get very disgruntled. They don't understand, why is their interest rate one thing, their friends is another, and the answer is within that credit report. And there's usually things that can be done. We can run a scenario generator that says, if you were to pay down a specific debt, or how much money would it cost to move things around, we can build that credit score up. The benefit for you, the realtors that are out there, is that if they can get a higher credit score, their interest rate is going to be lower. They'll be able to qualify for a more expensive home, or get into a home in general. So it's really great to help people out, to make sure they understand how this all works, so that when you're talking with them in the car and they're saying, oh, well, they're giving you information, you say, well, that's not really the case. Let's talk to an expert to make sure you're taken care of. So that's pretty much what I had wanted to talk about. We're right. It's amazing. We're right at 30 minutes. So what I wanted to do now is I'm going to open it up to any questions. So most of you probably know how to do a chat. If you want, raise your hand or just ping me, and I can unmute you so I can answer your questions for you. So fire away with what I can help you out with. No one's got any questions, really. I did such a great job. I knocked it out of the park. Okay, so if no one has any questions, then I'll just close this out. I really appreciate you guys jumping in. I know you're all busy, and it says something that you jumped on here to learn about, either whether you found it helpful for yourself, or you want to educate yourself a little bit about the loan side to be a better realtor and a better professional to your clients. That says something about your professionalism. So thank you for coming on today. I will have this PowerPoint presentation available if you're interested. I am happy to forward it on to you. I will have this sent out to everybody, and please let me know what questions you have. This is for informational purposes. So if you have clients that you're working with that you think might need a little bit of help, please forward this on. Whether I'm working with them or not, this is for them, to help them out, so we can do more business and get more people into homes. So unless there's any other final questions, I'll sign off and I'll get this out to you guys, and hope you guys have a great weekend.
Dad, I have a question.
Oh, yes. Hi, Denise.
Hi. Can you repeat the FICO score minimums for the different loans?
So the standards are one thing, and then there are going to be lenders that have different, more stringent rules. So, okay. So FHA is a minimum credit score of 580. It's really hard to do. Someone with a 580 credit score does not have a positive credit history. So there's some real hurdles, but you can get it through. Most companies, a guild requires a minimum of 600, and most other companies, especially now with COVID, have bumped that up to even 640 or 660 or higher. So check with your lender on what their minimum requirement is. It may be tougher. For VA, we are at 600. And then for a conventional loan, I believe the minimum requirement is a 620 score. I'd have to check that one, but it's going to be somewhere down there. I will tell you though, there's the costs on a conventional FHA government loan, they don't care so much about the credit score as it relates to the interest rate. On a conventional loan, it's going to be, the lower you go, the more expensive those costs can be. So on a conventional loan, 740 and above, again, would be perfect. Once you go below 700 on a conventional loan, the cost to add on for that lower credit score gets exponentially more expensive. That by the time you got to a 630 or a 620, I could never in good conscience tell someone to go with a conventional loan. You would be looking at a rate that's 1 to 2% higher than market, and probably 3 or 4 points. It just doesn't even work. So we would normally say FHA, but conventional, sometimes people really want it, but it will be more expensive with a lower credit score.
Okay, thank you.
Yeah. Yeah, absolutely. Good question. Okay. Any other questions I can answer for you? Awesome. Okay. Well, then it was great to see each and every one of you. I really appreciate the opportunity to help you out. I'll send this out to you on an email if you have any questions or something that you want to talk about offline. I'm here for you, and make it a great day, guys.
Thank you, Brad.
Okay. You're so welcome. Talk to you soon. Bye-bye.